Welcome to The Explainer. We're going to dive right into an absolutely incredible journey today. It's literally 1,300 years of economic history, and honestly, it plays out almost like a retro video game. We're going to look at how a localized currency evolved through centuries of total chaos to become one of the absolute most important pillars of the modern global economy.
So here's the big question. How did a historically isolated island nation basically invent the blueprint for modern global finance? It's a really fascinating question, right? Because when you actually look closely at Japan's bizarre economic experiments over the past few decades, you start to realize something crazy. They became the exact survival guide the rest of the world relied on during the 2008 financial crisis and, of course, the recent COVID-19 economic shocks. To understand the global economy we're living in today, you absolutely have to understand the yen.
Here's our level map for today. We're going to level up through 5 main stages. First, the pre-yen feudal chaos. Second, the birth of the yen. Third, miracles and megabubbles. Fourth, surviving the lost decades. And finally, stage 5, the modern yen era. All right, let's get into it.
Level 1, the pre-yen feudal chaos. Let's set the stage and look at the absolute monetary anarchy that existed before the yen was even a thing.
So early Japan actually suffered from incredibly weak central authority. Way back in 708 CE, they tried issuing this coin, the Wadu Kaichin, which was modeled directly on Chinese Tang Dynasty coinage. But there was a catch. They just didn't have the domestic mining to support it. So what happens? Citizens had to rely on a totally chaotic mix of barter systems. Literally trading rice, silk, and cloth just to get by and survive. Fast forward to the Warring States period, and you've got these regional daimyo warlords minting their own wildly inconsistent gold, silver, and copper tokens just to fund their armies. Just imagine trying to trade with the town next door, but your money is essentially worthless there. Total nightmare.
Now, Tokugawa Ieyasu eventually tried to centralize all this chaos, but in doing so, he inherently created this insanely complex trimetallic system that was just full of operational friction. You had gold in the north, silver in the south, and copper for the commoners. And the exchange rates between these three metals, they fluctuated daily, based entirely on merchants and market supply. It was basically a fragmented nightmare for any sort of interregional trade. And, this clunky system met its ultimate boss fight in the mid-19th century, when Western powers arrived and forced open Japanese ports. They took one look and immediately noticed a massive arbitrage opportunity. Since Japan's domestic ratio of silver to gold was just totally out of sync with international markets, foreign merchants swooped in and essentially drained Japan's gold reserves overnight. It was, quite frankly, an absolute economic catastrophe.
Which brings us to level 2, birth of the yen. To survive on the global stage, Japan knew they had to completely level up and reinvent their entire currency.
With the overthrow of the shogunate, the new Meiji government realized pretty quickly that rapid modernization required a stable, westernized currency. And so, the yen was officially born on June 27, 1871. Fun fact, the word literally translates to round object. This new currency wiped out the old, complicated Ryo system at a clean 1-to-1 ratio. For the very first time, it brought a unified monetary standard to the entire nation.
But, simply printing a new coin just wasn't going to cut it. To project undeniable financial stability to a highly skeptical global market, the new government legally anchored 1 yen to exactly 1.5 grams of pure gold. This was a massive, flashing signal to Western powers saying, hey, we're playing by your rules now, and our money is as good as gold. And this right here brilliantly illustrates the systematic steps the Meiji government took to deeply integrate the yen into the global financial architecture. First, they adopted a clean, structural decimal system. Then they founded the Bank of Japan in 1882 with the exclusive right to issue banknotes, which finally put a stop to all that private bank confusion. And finally, using war indemnities, they transitioned to a strict gold standard by 1897. This allowed the yen to stand proudly right alongside the US dollar and the British pound. Moving on to level 3, miracles and megabubbles. This is an era defined by the devastation of world wars, followed almost immediately by the most explosive economic power-up in human history. So following the absolute destruction of World War II, Japan's domestic economy completely collapsed into severe hyperinflation. Those old yen notes, they became practically worthless. To restore some kind of order, the Allied occupation authorities initiated the Dodge Line policy in 1949. They permanently pegged the yen to the dollar at a deeply undervalued 360 to 1. And guys, this was basically an economic cheat code.
It made Japanese exports incredibly cheap on the world stage, and that is exactly what kickstarted the legendary Japanese economic miracle.
But, as you might guess, this fixed era eventually had to collapse. By the 1980s, the US was running massive trade deficits with Japan. So the G5 nations got together and signed the 1985 Plaza Accord, deliberately crashing the US dollar against the yen. We're talking about the yen surging from 240 to the dollar down to around 120 in just a few short years. This sudden, massive appreciation, which is known as indaka, threatened to completely destroy Japan's export-reliant economy.
To cushion that terrifying blow, the Bank of Japan aggressively slashed interest rates. But, well, this cheap liquidity inadvertently pumped up one of the most absurd speculative bubbles ever recorded. Stocks soared, real estate completely exploded. Get this, by 1989, fueled by all this cheap money, the theoretical land value of Tokyo alone was worth more than all the real estate in the entire United States combined. I mean, no way, right? It was a mega bubble of truly epic proportions.
Level 4. Surviving the lost decades. Because, of course, every massive bubble eventually bursts.
When that bubble popped in the early 1990s, the deflation was incredibly violent. Asset prices crashed, leaving domestic commercial banks holding literal mountains of toxic, non-performing loans. Consumers panicked, they started hoarding cash and absolutely refusing to spend, and that triggered a deeply structural deflationary spiral. Japan suddenly found itself entirely paralyzed. The old economic rulebooks just didn't apply anymore, and they required entirely new financial mechanics just to survive.
And this is where Japan essentially beta tests the future of global finance. To fight this intense deflation, the Bank of Japan pioneered unconventional monetary policies over the next several decades. They dropped their benchmark rate to zero in 1999. In 2001, they launched quantitative easing, directly buying bonds to flood the system with liquidity. And by 2016, under Abenomics, they actually adopted negative interest rates. They were literally charging banks a penalty just for holding cash. These were radical, completely untested experiments that, crazily enough, the US and Europe would end up copying decades later.
But here's what's truly wild. Despite years of low growth and deflation, the yen unlocked a completely new identity. It became a global safe haven asset. Paradoxically, whenever global panics happened, like the 2008 financial crisis, international investors would just flood into the yen, driving its value way up. Why? Because underneath all of the domestic issues, Japan remained the world's largest net creditor nation. They held massive amounts of foreign assets, making the yen a remarkably safe harbor in a global storm.
And that brings us to level 5, the modern yen era. Let's look at how the macroeconomic landscape shifts drastically following the COVID-19 pandemic. As the world emerged from the pandemic, we saw a truly historic divergence. On one hand, you had the US Fed and the European Central Bank jacking up interest rates at a blistering pace to fight surging inflation. But meanwhile, the Bank of Japan stubbornly kept their rates in negative territory. They used yield curve control trying to protect their fragile domestic economy. And this massive gap in interest rate policies, it created a critical vulnerability in global markets.
Global investors immediately spotted this gap and exploited it through a massive carry trade. It's a fairly simple but incredibly powerful strategy. Basically, you borrow Japanese yen because the interest rate is practically zero, and you use those borrowed funds to buy higher-yielding assets, like U.S. Treasuries or American tech stocks that are yielding 5% or more. You just sit back and pocket the difference. But when trillions of dollars do this all at once, it puts immense downward pressure on the yen.
This relentless carry trade triggered a brutal depreciation. We saw the yen slide from around 1.3 per dollar in early 2021, all the way down to multi-decade lows near 1.60 per dollar by mid-2024. The bleeding was so severe that Japan's Ministry of Finance was forced to step in, executing these monumental multi-trillion yen currency interventions just to prop up their fallen currency. It was wild to watch.
And that brings us to the ultimate question for today. Recognizing that structural inflation is finally returning, the Bank of Japan has officially ended its negative interest rate policy. They're finally exiting this multi-decade era of hyper-easy money. Having navigated 1,300 years of feudal chaos, mega bubbles, and lost decades, we really have to wonder, if Japan is finally done beta testing these extreme policies, does this mark the dawn of a fundamentally new global economic era? It's absolutely something every investor should be watching closely right now. Thanks so much for joining me on this explainer, and as always, keep questioning the data.